Subclass 2.5, Miscellaneous Policy, Part 2. Engineering Insurance, Commercial Lines. Now, I know some of you are going to tell me, but we did discuss engineering insurance before, but in that subclass, it was specific about engineering insurance. This miscellaneous is basically like a summary of all the different types of insurance. So, hence, we're going to go through engineering insurance again and some others to follow. So, the description of cover, it would be possible to write volumes on the subject of engineering insurance. So, we can only hope to introduce this policy type here. Engineering insurance provides cover for large construction and engineering projects and include categories such as contractors all risk car insurance. Remember we talked about car insurance. That's not the vehicle you drive. It stands. Let's recap. If you forgot, car insurance is the C in contractors, the A in the all, and the risks, the R in the risks. That's your car. Also called contract works insurance or construction insurance. It's all the same thing. We're going to look at advanced loss of profits. That way, the engineer, the contractor, because of unforeseen circumstances, they're going to take longer to complete the project, and so they're going to lose on their profits because for every extra month they take too long, they must pay their builders their wages. At engineering project insurance, which is a combination. This one, engineering project insurance, is a combination of these two. We're going to look into that. So, so basically, a contractor can decide to either take this one. Let me just choose another. You can either decide to take only that one or only that one, or if he takes this one, it's a combination of both of them. And then machinery breakdown as well. Some does take machinery breakdown, others don't. So we're looking at engineering insurance, contractors all risk, or otherwise known as car insurance. Car insurance policies offers cover on all risks basis for physical loss or damage to the insured property. Very important. During the construction phase, not when it's completed and finished. It's during the construction phase. So while they are busy building the building, the policies can be issued over all types of buildings and civil engineering construction, and it includes normal residential housing, commercial property, and also the infrastructure. The main perils covered on the car policy are fire. There's things like fire and explosion, theft, burglary, collapse. If the earth collapses underneath the building, that do happen. In Centurion, we've got a couple of places that the earth collapsed and then the townhouse actually falls inside. There's one place I know close to Unitas Hospital, the complex, just one part of the complex, the last unit on the corner, the grounds collapsed and the whole townhouse just fell with, I think, a meter or 2 meters. But it's still standing, but it's just now 2 meters below. Yeah, so if you open the window, you look into the ground. But yeah, the people had to evacuate that property and so on very quickly. Um, Earthquakes, landslides, storm, floods, and any other disaster. Uh, it can happen. You see, it can be while they're busy in the building, especially during the earth collapse. Earthquakes will maybe split the building in two. Landslides, storms or floods that go rush through the building, destroying everything. And there might be an explosion. They might be busy fitting the gas pipes, and then the gas pipe uh, is not properly connected, gas leaking out, and the contractor standing next to it and want to lit his cigarette, and then kaboom, the place explodes into pieces. Hopefully, that contractor will survive. You see, so it's all those kind of damages which will set the whole construction phase behind. And because it's behind, it's going to cost more to finish, and it's going to eat the profits of the contractor and maybe end up making him bankrupt. The policy can also include a third-party liability section to protect the insured against third-party claims related to construction activities. Now, third-party claims, as we said before, once the building is signed off, or if you want it to be signed off, you get an inspector to do the inspection so that they can sign off, so that they declare it safe for humans to enter the building. And then while he's there on inspection, maybe a piece of the cement from the wall or roof fell on his toes and break all his toes. Now he needs to go into hospital for operation, and he's going to put in a claim against that contractor, third party claim. Now we look at advance loss profit. So basically, let's start like this. If there's any problem, the contractor will have a loss of his profits. So he needs an advance to carry on. So let's say he bargained, you want to build a house, you get the contractor, he tell you it's going to take 12 months, 1 year to complete. You bargain, you're still going to rent for 12 months, and then you're going to move to your new property. But because of the earth collapsing or the explosion or whatever, fire or floods, the contractor inform you, listen, we've got a problem. There was an earthquake, the building, half of the construction fell into pieces. We have to clean and fix it again. It's going to take us 6 months. Now, you need to rent for another 6 months, which you didn't bargain on. So you're going to tell him he must pay that 6 months rent. You're going to fine him 1,000 rand every day or every month, whatever is late. He only worked out on his budget that he can afford his staff, his builders, for 12 months. Now he must add another 6 months' salary. So now it's eating his profits. He's going to lose profits. So because he's got this insurance, they will give him an advance on loss of profits. In other words, they will give him money to pay the builders another 6 months' salary to carry on with the work and to pay all the fines and penalties and the money you are going to request from him for paying another 6 months' rent. So this policy covers the principal's loss of gross profit resulting from the delay in completion of the construction and or erection works. It cannot be issued as a standalone cover and usually issued alongside car. So you cannot take it on its own. You have to add it with your car policy. Indemnity is limited to the actual loss of gross profit sustained for the duration of the delay in the completion of the project, which delay must be caused by an event covered under car. Normal working delays are not covered. So yes, if you things that you start working late and you leave early and you fall behind, that is not covered. No. And then you look at project engineering, project insurance. Now, as I said before, this is an insurance policy that combines a number of typical engineering project covers into one. So it's a combination of car insurance, of the third party liability insurance, and of the advance of loss of profits cover. You see, so engineering product insurance is a combination of car, third party liability, and advanced loss of cover. It's a combination of all of them. Then when we look at machinery breakdown insurance, this policy indemnifies against sudden and unforeseen physical loss or damage to machinery which has been erected at the construction site and is operational or at rest. So it will be those machineries, like the cranes, which they put next to a big block of flats or big office blocks that they built. They've got these cranes at the top, and then you've got the crane driver climbing up the ladder, and then They picked up stuff from the ground, they hoist it up, and then they put it on the roof so that the builders can carry on building higher and higher. Um, and those cranes, they normally leave there because it takes a long time to erect and also a long time to break them down. You cannot do it every day. It can be, thought of as accident insurance for machines and provides for internal breakdown, not wear and tear. The policy is performed by paying all the repair costs up to the value of the machinery at the time of the loss. So whatever um, uh, breakdowns there is, if there are, that the insurance will pay for all of that. But in other words, to the maximum indemnity is the current value of the machine. They will not pay more than the machine is worth. So if the crane is worth 1 million rand and the breakdown is 1.1 million, they will only pay 1 million rand, and the other 100,000, well, the contractor has to fork out himself. They will not pay more than the current value of the machine. Marine insurance. Marine insurance is split into two components, namely risk at sea, also referred to as ocean marine, because the sea is the ocean, and the risk on land or inland marine. Okay, so think of sea is ocean, and the risk on land is inland. Okay, then you know which one fits where, if they're going to try and confuse you in exam. Ocean marine is a term discussed under three main categories, namely, that we're going to look at the hull insurance, the cargo insurance, all the things that's loaded onto the ships, and also protection and indemnity liability for third parties. So, commercial hull insurance indemnifies vessel owners against loss or damage of their ships, whether at sea or inland waterways, and places a value on the cargo that a particular vessel is carrying. So they will say the cargo that vessel is carrying, let's say for instance, is 100 million rand. So yes, so that's the value that needs to be, and the ship's value. That's the cover that the insured needs. It covers accidental loss or damage to the insured craft, whether a fishing trawler or an ocean-going supertanker. Smaller craft will most likely be insured on personal lines or commercial policy rather than on a big ticket marine insurance policy. So yeah, your boats that you use weekends to go ski or fish, that will go under personal lines. Or if you make a living from your one boat um, for fishing, then you'll put that under commercial policy, but not on the big ticket marine insurance. Marine cargo insurance, meanwhile, compensate owners of cargo for losses due to accidental loss or damage in transit due to fire, theft, or shipwreck. The cargo is covered for the full duration of the journey and typically includes transit from the seller, a factory or a warehouse in China, for instance, to the buyer, a retail distribution center located in Johannesburg. So from the moment it's on the ship and then on the trucks until it comes to the distribution center in Johannesburg, it will be covered. Cargo insurance is an important enabler for cross-border trade, as banks will not discount a bill of exchange unless marine insurance is in place. So you have to have the marine insurance in place. The purchaser of the goods must lodge a certificate of insurance with the bank as collateral for the deal. You should know that cargo insurance is not limited to the marine world and can be issued for cargo being imported or exported via air, rail, and even by post. So, yes, if you post it, it can be insured. If it goes via the aeroplanes, it can be insured, or even by rail, by train. So the marine advanced loss of profits cover can be included as an add-on the marine policy to provide cover for loss of profits and the increased cost of working that results from a loss of production or turnover. or a delay in start-up following loss of or damage to imported critical equipment covered by a marine cargo policy. Travel insurance. Travel insurance provides cover for a range of losses that an insured might incur while traveling. The bulk of this business is written for those traveling aboard, but policies are also available for travel within the borders of South Africa. That is why if you're buying a plane ticket to fly to another country and you buy it with your credit card, you automatically get 3 months international travel insurance. Or you can also get it in South Africa as well. The main insurers active in the travel insurance space offer a range of products for both individuals and firms and can thus be categorized under either the personal lines or the business insurance categories. The travel insurance sum insured. The sum insured vary widely across an insurance policy and are typically included in the policy wording per insured event. Most travel insurers offer a range of cover based on the potential insured's needs, similar to the comprehensive versus third party offerings in the motor vehicle space. Hollard, for example, describes its travel insurance under the headings comprehensive, premier, medical, business top up, or visa and senior. So, different companies will have different headings, but that is how Hollard describes their insurance. Determining the travel insurance premium. The premium charged on a travel insurance policy is based on the benefits chosen by the insured, the sum insured for each benefit, and something different from other short term insurance policies, the duration of the cover. A travel policy is not renewed on a monthly or annual basis like most of the other cover described in this book, but is rather calculated for a fixed duration of less than 3 months or up to 3 months, depending where you buy it from. A single premium is charged and a premium is higher the longer the cover period is selected. So they will charge you a single period, let's say for 3 months, but if you say you want it for 4 months, they will add some more money, or 5 months some more, but it will just go up and up and up. Yes, so it will become more expensive the longer you want it. Cattle and livestock insurance. Farm animals, cattle, and other livestock face mortality risk caused by accidents, sickness, and disease. I know some of the farmers lose their cattle by fires, lightning strikes. Um, they lose cattle for falling into rivers and get stuck in the mud. They can't get out, then they drown. All kinds of things. There are coverage that apply to most animals, livestock, and poultry, and specialty covers for specific groups of farm animals, such as cattle, sheep, goats, pigs, hogs, chickens, and emus, or a combination of these on your farm. Now, for you who don't know what emus is, emos, you can go and Google it. It looks like an ostrich. It's just much shorter and smaller, but it's basically also a two-birded a bird like an ostrich. The animals and livestock insurance products are normally designed around the specific needs for the farmer's herds and stud animals. Agriculture is an important contributor to the South African's GDP. Commercial farming business are so distinct from other commercial concerns that the subcategory of insurance has evolved, namely agricultural insurance or agri-insurance. All right. This category of insurance combines a number of standard business categories with agriculture-specific solutions. Insurers of crop risk distinguish between so-called direct perils and systematic perils before indicating the types of crops that can be covered for each set of risks. So we turn to leading short-term insurers Santam and Zurich for an overview of some additional insurance components that can be incorporated into a comprehensive agricultural insurance policy. They said that the following can be incorporated: property and vehicle insurance, of course, the house on the farm. What do you do when that burns down? Um, Vehicle insurance, the farmer's buckies, uh, one that he drives around to town to go and buy stuff, and the other one that stays on the farm. They need to be insured. Engineering insurance, liability insurance. Who's going to take the responsibility and who's going to be held liable if there's some damages to people on the farm, whether it's staff or clients or yeah, third parties. Liability insurance and crop insurance. So then we look at householders or household content insurance. Householders or household content insurance is fairly self-explanatory in that it provides for loss due to theft, break-in, or accidental damage to household contents. The cover is restricted to goods contained within the home unless otherwise specified. It is categorized under the property insurance class. So the householder's policy sum insured. One of the most common mistakes that insureds make is to underinsure their household contents under this section of their insurance policy. Underinsurance only becomes an issue at claim stage when average will apply, leaving the insured out of pocket. It is therefore important to make an accurate assessment of the household contents alongside estimates of the replacement value of such contents. So now your claims history and no claims bonus. As in the case with personal lines motor and personal lines homeowners policies, many insurers offers no claim bonuses with the householder's insurance policy. These bonuses are usually paid back to policyholders as a cash sum following a predetermined number of claim-free years. So, no claims bonus means every year you don't claim, you get a bonus. It's built up until 5 years has passed. If you haven't claimed in 5 years, you get that money. That is the way the insurance people protect themselves from people just claiming for small nitty-gritty stuff because they want that claim-free bonus. Some insurers will only implement their no-claim bonus plan if the insured holds a portfolio of covers, including motor, householders, and homeowners insurance. And that's the end of 2.5 part 2. If you've got any questions, you know what to do.